Hello everyone, this is Sean Spalding, your instructor for Financial Accounting, BUS120. We are transitioning now to merchandising businesses. So up to this point, we've kind of been learning about the accounting cycle, right? Talking about the various aspects, including journalizing, posting to your ledger, your T accounts, your trial balance, adjusting entries, etc., etc. And again, we were doing that kind of through the lens of a service business. And a service business is one that just collects money for the services it provides. Whereas now we're talking about a merchandising business, which is going to be selling an item of inventory and trying to make a profit off of that. So we're going to talk about the new accounts that we'll find on the financial statements and the new types of entries that we'll be making in the journal. Specifically, we're going to break up Chapter 4, Module 4 into 2 weeks. The first part here is going to be about describing the relationship among manufacturers, wholesalers, and retailers, and then also the customers. We'll also be defining the periodic and perpetual inventory systems. We'll also throw in some information about the specific identification type of inventory tracking as well. And then we'll learn to journalize transactions for the purchase of inventory. And then, like I said, the remaining learning objectives will be covered next week. Okay, so we're going to describe the relationships here for merchandising types of businesses. And with, as I mentioned before, merchandising businesses, we've got inventory, right? That's going to be a new asset that we're going to be dealing with on our balance sheet, and we're going to have to track that. We're also going to be talking about the cost of goods sold, and we'll get into more about that later. But here we're going to talk about the relationship, right? So first, you've got the manufacturer in a typical setting. You've got the manufacturer. This is the business that's going to make the product. So they are creating it, and they're, you can kind of think of it like the factory, and then they're going to sell it to either a wholesaler or directly to the retailer. And so the wholesaler is one that purchases, this products, the inventory from the manufacturer, and then they go out and shop it around to retailers. And then, like I said, some manufacturers have relationships directly with the retailer, kind of. You can think of the wholesaler as kind of the middleman in the operation. And here's an illustration to kind of show you what that looks like. Here we've got the manufacturer shipping here to the wholesaler, who then sells it or ships it to the retailer. And then we have the customers over here that purchase the product, versus here the manufacturer just selling it directly to the retailer. Okay, so that's pretty straightforward, but that's kind of in a nutshell what we're talking about here with the retail or merchandising type business, right? So now we've got to define the periodic and perpetual inventory systems. Pretty straightforward. The periodic inventory system is a system of accounting for inventory that does not keep a continuous running record of inventory as is bought and sold. Instead, you basically can think about, for those that have worked in kind of the retail setting, you probably remember going through and doing your inventory at the end of the year, and which is typical. Whatever, if it's a fiscal year, it could be any month, but if it's a calendar year, sometime in December, you have to go through and count all of your inventory to see what you have, and that's what we're talking about here with a periodic inventory system. And I'll show you the formula here as well. So basically, you've got each year. Right, you've got a beginning inventory, so you've got a list of all the inventory that you have in the store, and or the warehouse, whatever the case may be, and it's got a value to it. And so your beginning inventory is $1,000, and then during the year we know how much we've purchased. Say we've purchased $2,000 of inventory, therefore we would have $3,000 of cost of goods available for sale. And then we do our inventory right at the end of the year, and we say, okay, what do we now have in inventory? What's left in inventory? And let's say it's $1,500. So then you would subtract the $1,500 from the $3,000, and then your cost of goods sold would be $1,500, and this would be the expense that shows up on your income statement. Okay. Now today, a lot of businesses have transitioned because of upgrades in technology or whatever the case may be to a perpetual inventory system where the inventory is tracked kind of as it is sold. So you always know how much inventory you have in the system, and this is done again through perhaps through scanners and the like that again make it possible for businesses that are selling like a Target that are selling multiple types of products to keep track of that effectively. However, they still have to do a physical count of inventory at least once a year, and this is again to determine if any goods have been lost, damaged, or stolen, right? So that kind of makes sense. Those wouldn't be picked up on the scanners, right? As people are buying products, you wouldn't see if somebody stole it. It wouldn't have been recorded. So you've got to capture all of that in the process of doing a physical inventory. But it does allow you to track it more accurately during the year. And then real quick, we'll talk about specific identification. There are some businesses that use specific identification, which means that each item, and this we'll talk about when we get to the cost of goods sold, but essentially I think like a car dealer or a fine jewelry establishment, that they'll know how much they paid for it. That particular item will be like, okay, we paid this much money for this car, and when we sell it, we know that the cost of goods sold here should be assigned to that exact vehicle. Whereas when you're selling a bunch of toilet paper or toothpaste and things like that, you may have purchased it from the wholesaler or the manufacturer at various prices. So the costing can get a little bit, or it has to be averaged or calculated some way to estimate it versus the specific identification. But I just wanted to point that out before we get to that when we go through the costing that comes into play. Okay, so now we'll talk about journalizing the transactions for the purchase of inventory. So we've got the different types of journal entries, right? We've got cash purchases, where we'll see our cash asset being utilized. We have credit purchases, so on account, so accounts payable, and we'll see accounts receivable as well. Purchase discounts, we'll talk about what that means, and then purchase returns and allowances are another wrinkle. So cash purchases, pretty straightforward, right? Assume Bold City purchases 60 hats from Mad Hatter on March 1st at the cost of $15 each. The total value of Bold City's purchase is $900. So the journal entry here is inventory is going up, right? Inventory is an asset. Assets go up with a debit, so inventory is going up $900. Cash is also affected here, so it is going down. We're spending the $900, so cash, also an asset, goes down with a credit. So pretty straightforward on the journal entry, right? And then we've got credit purchases. So we've bought it on account, right? So businesses that sell to other businesses often grant credit to their customers and allow them to make purchases on account. Assume that instead of paying cash for the 60 hats, they purchase it on account. So here, again, inventory is going up $900, but accounts payable is going up. Accounts payable is what? So liability. Liabilities go up with a credit. So again, pretty straightforward. Now let's talk about purchase discounts. So a sales invoice is a bill that documents the sale of goods to a customer. The invoice includes credit terms or the payment terms for customers who buy on account. So one of the things that when you're offering your customers credit terms is that you also, or you'll typically see, particularly for this class and for these large types of transactions, you'll see purchase discounts on those invoices where you say, hey, yeah, you can purchase it on account. If you pay it off in 10 days or 5 days or whatever the day amount is, we'll give you a discount. We'll give you a 2%, 3%, 5%, whatever the discount is. Whereas if you pay it off in the full 30 days, you'll just pay the full price for it. So that's what we're talking about with purchase discounts. It's basically we're identifying the discount period that they're offering us, if they are offering us a discount. So the discount period is the period in which the customer can make early payment for a purchase and receive a discount on that purchase, right? A purchase discount is received on purchases for paying early within the discount period. So using the example that we have the $900 purchase, right? So let's say the credit terms were 2-10 net 30. What does that mean? So that's 2% discount if it's paid within 10 days. Full payment if it's paid within 30. Okay, so that's basically what the 2-10 net 30. So the 2 is the percentage off, the 10 is the amount of days for the discount period, and then net 30 is otherwise when it needs to be paid off. So pretty straightforward there. Let's take a look at the invoice and what it would look like. Here we see the unit price, $15. We're buying 60, that equals $900, right? And then we've got our terms up here, 2-10 net 30. So this would be what you would look at. But either way, even in the fact patterns for the problems that we'll be doing, you'll see it'll be set just like that. It'll say 4-15 net end of month, or EOM, right? Or net 60, or whatever the terms are. But you have to be mindful of that so that you can input the correct number when we're journalizing, because it does affect it, because we are going to be using what's called the net method for this, which basically is going to recognize the discount, because our business is one that typically takes advantage of the discount. So we're just going to treat it as though we got the discount from the outset. Because remember, in accrual-based accounting, we're recording this transaction even though we haven't paid the money. And so to limit the amount of journal entries, we are just going to, again, use the net method, which will apply this to the invoice. So basically we'll see here in the next couple of slides what that is going to look like in your journal entries. But basically it's going to be a 2% discount on the $900, so $18 off, right? Okay, so if Bold City pays within the discount period in March 8, we'll pay the $882 and the 98% of the invoice amount, right? So $882. So the entry is going to be, again, recognizing this from the outset. So we're going to use the net method to record the purchase. So inventory is going to be debited $882, and accounts payable is going to be credited $882. Accounts payable is a liability. Liabilities increase with a credit. If they pay the invoice on March 8th, which is within the discount period, records the payment as follows. Accounts payable, $882, cash, $882, right? So accounts payable is going down because we've paid it off. Our liability is going down. Liabilities go down with a debit. Cash is also going down because we're paying the money out. So cash is an asset, and assets go down with a credit. Okay, so if Bold City pays this invoice on March 24th, which is after the discount period, it must pay the full amount of the invoice. So how do we record that? How do we capture the $18 back? Well, it's pretty straightforward. We have our accounts payable, which was $882. We're going to remove that essentially, right, by debiting it, because now we've paid it. Now, what do we have to do to make the numbers match, though? We have to increase our inventory. So our inventory cost is actually going to be $18 more because we didn't get the discount. Remember back to the entry that we would have had where inventory was going up $882. Well, now it needs to go up another $18 to get us up to the $900. So this is the compound entry for that. And then cash, we paid $900. So cash is going down. Cash is an asset. Assets go down with the credit. Okay, so this also applies to partial payments too. So let's say you can only afford to pay half of the invoice within the discount period. So you would get 2% of the $450, which would be $9. So the entries would be the same, but you would have another entry later in the month that captures the remaining amount. So here we've got accounts payable for $441, cash for $441. Then after the discount period, and we've got to pay the rest. We've got the accounts payable, $441. The inventory is $9, and then our cash is $450. So this is for the payment on the remaining invoice. Okay, purchase returns and allowances is pretty straightforward. We're running out of time on this. These slides will be in here but essentially you'll be backing out the transaction. So say somebody returns the entire order because it's the wrong color shirt. You'll just basically reverse the entries that you put in there. Okay, so I will talk to everybody next